Well, g'day traders, Chris Weston here, Head of Research at Pepperstone. It's that time once again where we're looking ahead at what potentially can be. We're trying to set the stage for you to do a bit of preparation, whether you're running a systematic or algorithmic strategy. You just want to understand the backdrop by which the market is anticipating volatility. I think that's just absolutely central to everything we do as traders. It defines what strategies you're going to use. It defines risk management, money management, and position sizing, and various factors there, whether you want to hold positions as a discretionary trader over the events, and ultimately what the market's anticipating for those events in terms of those potential price moves is up and down from spot, and the degree of confidence around that. So that's what we're looking at today. But let's set the stage and look at how currencies in major currencies have fared over the last 5 days. I guess it gives us a good platform by which we can progress. And ultimately, if you have a look at this chart here of major currencies, developed currencies against the US dollar, you can see it's been the Great British Pound doing the best in those currencies, certainly the best in G10, up 82 basis points. That's something we're going to be looking forward to as we approach the new week. You know, will we see the Bank of England cut rates at the back end of the week on the 30th of November, 30th of January? The market at the moment, we'll go right through to the rate structures in a second, but the market is sort of a coin toss at the moment. I am saying this just before the PMI numbers that come out tonight, so obviously people will be focused on that. They're going to have to be pretty dire, in my opinion, for the Bank of England to cut rates. I still sit in the camp myself that we will see a dovish hold from the Bank of England. But you can see the the pound really reacting to things like the CBI business confidence numbers and various factors. Then we started to see some yen outperformance. The Japanese yen up 57 basis points against the US dollar. I still continue to see a slight downside risks in dollar yen, but if you look at things like the Chinese offshore currency, the CNH, the offshore yuan, relative to Japanese yen, we've started to see that roll over. I think that's a good proxy of risk, but the yen's starting to find a bit of a bid in this market. Obviously, everyone focused on what's happening in China. That's ground zero for the coronavirus. I think the fact that we've got 20 odd million people being confined over 4 different cities has untold consequences. I think they've played out there. We have seen one really very prominent Chinese virologist coming out and saying that because of the time it takes, the time for action has now passed, and he actually sees the likelihood of being this 10 times worse than SARS. We'll have to see. The market has still got this very much on edge at the moment. What will ultimately be the impact here on things like Chinese tourism and things like retail sales, and ultimately the GDP going forward? If it's going to be worse than SARS, then we can expect to see the PBOC having to come out and support price action and support the economy, and that's probably why we're seeing dollar CNH moving a little bit higher in this environment. People are anticipating maybe some support from that. Elsewhere on the bottom of the pole, you can see Aussie dollar down 55 basis points. It has had a bit of a lift, obviously, from those employment data that we saw yesterday. I will caveat that by saying all of that has been in the part-time side of things, but the RBA obviously looking at the employment rate dropping from 5.2 to 5.1%. We will be looking at the CPI numbers that come out midweek in the new week. I think that could be influential for the Australian dollar. The market is expecting headline inflation to be at 1.7%. Core inflation, if you look at trim mean, which of course is one where the RBA look at very closely, that's down at 1.5%. The bottom line there is that's a very soggy inflation number. That does give the RBA fodder, given that they're effectively going to be missing, if it comes out there those levels, 19 out of 21 quarters, so would have been missing their inflation mandate. But the market, and we're looking at that rate structure, has pared back the idea that they're any kind of need right now to be looking to do more monetary easing. We've seen a number of prominent economists changing their call, ANZ, CBA, Citigroup, all changing their calls recently to away from February, pushing it back to March or April time. So that CPI number definitely something we're watching. But the Aussie dollar getting towards that bottom of the pile there, certainly the Korean won, and also the Norwegian krona under a bit of pressure. Norwegian crown under a bit of pressure, being the worst performer. So the best trade of the week so far has been long the pound against the crown. Obviously, spreads are a bit punchy on that one, so it's not something we see too much business in. Going into the emerging market complex, see how they've done. It's the renminbi down the bottom there. Obviously, everyone, as I talked about there, really anticipating that the PBOC may have to step up there. The coronavirus, obviously still lots to play out there, and we still don't really know how that's going to affect the Chinese economy going forward. So obviously people selling the renminbi in that situation. But we've seen some selling playing through in the Colombian peso, the Turkish lira, the Korean won, the Mexican peso. And if you go through to the next chart, I think it's really interesting because what we had been seeing over some time is this emergence of the carry trade, which has been really very much in vogue. The backdrop, of course, and what promotes that is this very low implied volatility structure. We've seen record low implied volatility on the JP Morgan Global FX Index. You've seen record low 1 month implied volatility in euro dollar. You know, the FX market's obviously lacking any kind of pulse, but then you see better liquidity from the Fed. The excess reserves are being increasing, not just the balance sheet. You know, economic data has been improving a little bit, but we haven't seen real yields moving. Everyone goes into the carry trade. You can see that really from, you know, August of last year. You can see that really strong trend higher in the carry index. People using those higher fund carry trade. Wanting to be paid to be in a position. That started rolling over a little bit. As we talked about there, these emerging market currencies had done very nicely there as well. So we are watching for signs that volatility crack up. The fact that carry trade is starting to roll over is giving us some idea that perhaps currency traders are seeing better opportunities back into some more risk-averse currencies like the Swiss franc, perhaps going back into the Japanese yen, which we've seen outperforming there again. And I think that's something that we do need to consider. Now, I think if we go through a couple more charts, what I think is going to be interesting, if we go to the event risk of the week, we talked about what's happening in Australia with the CPI numbers. I think that could be quite influential on rates pricing in the Bank of England as well. You know, that's a toin cost. I think my base case for the Bank of England is that they will keep rates on hold. The pound's going to be a very interesting currency as we go through this rate. But if they do decide to keep rates on hold, I do believe personally that they're going to offset that, caveat that with a fairly dovish outlook as well to keep the pound suppressed. The highlight of next week, in my opinion, will be the Fed meeting. Obviously, they're not expected to raise rates, or they're not expected to cut rates. There could be some changes to interest earned on excess reserves and market banking, that perhaps there's a chance that they could raise interest earned on excess reserves by 5 basis points. I'm not sure necessarily you're going to have too much of a reaction in the dollar or any of those modes. It's mainly a rates play and what's happening in repo. And that's what we need to look at. Is it going to be a guidance around what's going to happen on the liquidity front, or what they're doing in terms of trying to support the liquidity in the repo market, the money markets, and I think certainly the guidance around their balance sheet. Because if you have a look at this chart here, you can see the yellow line is effectively the assets that are coming on the Federal Reserve accumulating on their balance sheet. So when they're buying T-bills, when they're buying various duration assets or short-term duration assets, you can see that balance sheet's been expanding. The white line there is excess reserves. Remember, the Federal Reserve wanted to increase excess reserves. They wanted to get excess reserves somewhere above 1.45 trillion. Now, those excess reserves sit at 1.53 trillion. They're getting to levels now where the Fed are going to have to give guidance around that. Now, you can see here in this one that since that balance sheet started to expand, that's given the S&P another leg up. Now, the question is, of course, is if excess reserves and that balance sheet starts to plateau, and that's something that we might find more of, from a very, very simplistic perspective, are we going to start seeing risk assets missing that natural or that unnatural, that very unorganic, that orchestrated catalyst that we've been seeing? So if that white line starts to move sideways, which we expect it to do in the coming near future, is that going to mean that the equity traders start to take a bit off the top? If you have a look at how the dollar's fared under this regime, where we've seen excess liquidity being increased by the Federal Reserve, you can see that there's been a hindrance and a headwind for the US dollar as well. So again, from a very simplistic perspective, and I'm not a repo expert by any means at all, what we're going to be taking the idea is if that excess liquidity starts to reduce or perhaps move sideways, is that going to be a catalyst for the dollar to find more stable times, perhaps even move a little bit higher in that regard? So I think the Fed meeting, well, we're not going to see too much there. The Fed are going to be probed, not just in their statement, but also in the question and answer time where Jerome Powell's going to be fielding about that balance sheet, what's going to happen with the repo market and also liquidity. And I think that's going to be potentially a big driver for markets there as well. What I think is really interesting, if we're talking about what's going on there, we can talk about the global economy and what's happening in currency markets. There's a few charts which I think are really interesting. Now, talk about what's happened in liquidity. If that liquidity starts to subside, we talked about there. But have a look at this one now of the US 10-year Treasury. Now, that's sitting at the bottom of the range, around that sort of 173 level. You can see that sort of lower horizontal level. It's just looking like it wants to crack the uptrend since August. If that starts to move lower, if we do see US Treasuries start to move lower, if that curve starts to flatten out, despite all these calls that we're miles away from a recession, despite all these calls that we're going to be potentially seeing Better times ahead of us, this reflation trade, which has been causing cyclicals to outperform, people starting to look at growth stocks again, quality stocks. Their 10-year is telling a story now. If it breaks through that trend line support through that bottom of the trading range, that could be something that actually causes a pickup in volatility as well. Now, if we have a look at the TLT, which is the 20-year ETF, again, although you've got a pennant pattern in place here as well, that's telling us something that's a bit worrying. People are starting to buy the long end of the curve. People are starting to buy duration assets again. That's telling us that perhaps all is not well in this market there as well. So you can play that through the TLT and the ETF front. Have a look at this chart here, which I think is really, really important for me as well. We talked about everyone saying, oh, the world's great. We're going to see better times ahead. Well, have a look at the orange line here. This is 10-year real yield. So this is inflation-adjusted 10-year treasuries. We talked about that breaking through the bottom end of the range perhaps, but the real yield, the inflation-adjusted yield, the one we look at most commonly, has never really bought into this reflation trade. That's rolling over quite sharply. The yield curve, which everyone said, oh, it's going to see steepeners playing through that. We're going to see the long end really selling off and we're going to see that kind of bear steepener playing through. Well, 10-year euro yields, that correlation broke down sort of back end of August into September. But that we could see that yield curve starting to flatten out. I've looked here at 3-month versus 10-year treasury yields. If that starts to flatten out, I think the equity story will look at that pretty closely. You probably will see high yield spreads moving wider against investment grade spreads. I think credit spreads more widely will widen against risk-free rates. And again, that's something that could play a hindrance into risk. If we do see those real yields moving lower, if we do see the yield curve flatten out with outperformance from the back end, I do personally think that we're going to see volatility pick up a little bit. I do personally think that we're going to see risk assets like equities start to struggle. Maybe that's a factor that plays through the Fed and what happens where they talk about their balance sheet, because that natural driver is coming to an end. But the fact is the bond market is telling us something pretty clearly here. Have a look at this chart as well. I'm looking at the copper-gold ratio. People use copper as a sign of reflation. We play that against, effectively the store of value, which is the gold price there. You can see that ratio of copper versus gold, the white line is rolling over. Have a look at the green line, which is the 10-year break-even. We use this to measure our market's expectations of inflation expectations over an average period of 10 years. That has a very strong correlation with this copper-gold ratio. You can play inflation expectations through that copper-gold ratio. That's telling us now that's rolling over. So this reflation trade that everyone was abuzz with at the beginning of the year is starting to come to an end. That break-even level is rolling over now. That's going to have big implications. If inflation expectations start to fall, again, central banks may have to look at this more closely. The idea that rates have been priced out of markets, if this starts to fall again, that's something we are going to be looking at very, very closely. So just a few charts that I am a little bit concerned with. And if we go to the rates market, have a look at the rates market and what's being priced in. Go to that third column. You can see the Bank of Canada, after turning somewhat more dovish at the margin, the rates market's not fully buying that they're going to cut anytime soon. In fact, at the next meeting, they got a 25%. So a 1 in 4 chance that the central bank there come and cut rates. There was a bit of a hindrance to the Canadian dollar, but I say the rates market's not fully buying that. Go out further down the curve and the Canadian rates market, swaps market's pricing in one cut over the coming 12 months. Pretty much in line with what we're seeing with other central banks there. Have a look at the Bank of England. As I said, we're talking really about that Bank of England meeting towards the back end of the week. Market now pricing in a 60% chance. My base case is we get 6 MPC members, voting members, calling for that, and then we're going to see a number of the rest of the remaining bunch of 9 saying that's going to be on hold. There's going to be a lot of people who disagree with me. I get that. Certainly the rates market saying that on balance they expect to cut. I do see a situation where we could see a higher sterling if they do leave rates on hold. Sterling CAD would be my choice there. I think when the Bank of Canada are turning a bit more dovish, I think there's some upside in sterling CAD. But obviously when you've got a coin cost around that, personally I wouldn't be looking to hold positions over that. But if you are running an algo, and do keep in mind that this meeting could be a volatility event in itself, so that could be something that you shy away from. The Reserve Bank, you've got a meeting now on the 4th of February. The market's giving that a 1 in 4 chance that they cut. Now, obviously, that's come down from around 60% pre-jobs. That CPI number, though, if we do get a really weak number, bear in mind that those in place, we could see a little bit of move, or a bit of a sell-off coming through in the rate, or a bit of a bid coming through in the rates market. The Aussie dollar could find those headwinds playing through, as we do see that implied estimate of being what's being priced in push up towards 40-45%. We do see a strong number, though. Yeah, clearly a rate cut in February is fully off the cards, and we should see that rates pricing closer towards 0. Aussie dollar gets a move back up towards 69 and plus. RBNZ, we've got a 5.8% chance. So Of these central bank meetings, we've got the Bank of England and the RBA ones, which we're looking at a bit more closely. Bank of Canada, what's left in the tank there. Now let's have a look at what we're really looking for. Let's have a look at the implied volatility structure. They have picked up a little bit from last week. Last week we looked at some really just absolutely horrific numbers in terms of what was being priced into straddle pricing, that sort of 68.2% probability of what prices might fare from current spot up or down. So we go to that middle column, we're looking at 1 week at the money implied volatility. The market's anticipation of price moves over a period, which we've got the expiry being 1 week. You can see cable implied vols at 8.2%. So they picked up a little bit, but they're still 22nd percentile. So despite the fact we've got a Bank of England rates meeting, the market's saying, on balance, we only see cable moving 128 points up or down from current spot prices. Of course, we can go to a bigger outlier, look at 10 delta strangles. I haven't put that down here, but the market's saying on the week that they expect cable to trade 132.50, 120, so 130 the figure effectively, but the implied volatility is still pretty low. Look at euro dollar. That's been absolutely disgusting. I talked about that last week. We talked about implied vol on the 1 week being 4.18%. Again, 23 percentile. It's picked up. The market's pricing a 55-point move up or down, so 110-point range in euro dollar with a 68% level of confidence. I'd imagine that realised when we see that in hindsight actually makes up lower than that. But what we've got a situation in here where you can see the highest expected move in terms of the week being in cable. That doesn't surprise given that coin toss that we're seeing there. Aussie yen vols have picked up a little bit. They're 34th percentile, 72 pip move expected there. We've got realised volatility for those people who do use realised volatility for position sizing using average true range and Bollinger Bands, just to get a sense of that. I'm looking more closely at what's happening in implied vol and what the market's expecting there. That has picked up a little bit just as a result of the fact that we do have a lot more event risk this week with the Fed, the Bank of England, with CPI in Australia, and of course keeping an eye firmly on what's happening in China when those markets are closed for Chinese New Year. Have a look at some of the other asset classes. We look at the VIX, which measures the 30-day implied volatility in the S&P. 14th percentile, still very low. The market's not expecting big moves. I think that's misplaced. We'd be starting to expect to see somewhat higher volatility in equities, but that's going to be conditional on the bond market breaking down, as I talked about there. Bit of volatility in gold, 32nd percentile. And oil, actually, it's really incredible to see implied volatility in the gold market at 14th percentile, 32%, when, effectively you've got the market testing that long-term trend line and it's been having a big move there. So interesting to see what happens with oil. If oil breaks down further from here, you could see those bond markets to continue to find a bid. So all in all, we're continuing to what's happening in the Fed. What are they going to say about the balance sheet and ultimately their repo operations and liquidity? Australian CPI, Bank of England, it's all there, but I'm watching the bond market. If that continues to crack, I reckon we're going to see higher volatility start picking up in other asset classes.